please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome. You're watching Business Lunch. I'm Nisha Podar, and with me, as always, is my co-anchor Sonia Shenoy. Sonia, good afternoon. Markets trending lower at lunch hour, as we can see. The lowest point of the day on Nifty 50. It has just turned into the red, and that's not a good sign at the moment. In fact, take a look at the overall markets. The Sensex has dropped. The only saving grace is that Nifty 50 is just about holding on to the 10,700 level, but is really going down fast. Mid-cap index, that's where most of the worry is really coming in from, because it has dropped in the last 10 minutes by about 0.2%. So keep an eye out on that one. But Bank Nifty, that is really in the green, over 0.5% at the moment, and a lot of it is really led by ICICI Bank, Sonia.
Absolutely. You know, I mean, overall, you'd have to say that it's not such a bad market. Yesterday, we had a huge run-up. The last few days have been very good. So maybe just buying time around these levels, maybe, you know, just consolidating. The 10,700 level is still holding on the index. So I guess psychological levels have been achieved. For now, it's just ambling around this zone. Of course, the mid-cap index is under quite a bit of pressure this afternoon. So don't lose sight of that. But let's talk about a lot of the global markets, because across the globe, Asian markets have closed higher, with the Nikkei reversing its early weakness and ending higher. The European markets open mixed. Investors are now waiting for President Donald Trump's decision on the Iran deal. Remember, President Trump tweeted that he would make an announcement on a possible decertification of the Iran nuclear agreement, and that comes in later tonight. So we'll be reacting to that tomorrow morning.
Yes, lots of global cues to look at, but I really can't take my eyes off ICICI Bank. Let's take it straight to that. That stock is up over 7% in trades right now, and ICICI Bank, remember, reported its fourth quarter numbers, and the stock right now is the top Nifty gainer. Let's take it straight across to Abhishek Kothari to decode the numbers and also what really the brokerages are saying about ICICI Bank. Abhishek.
Well, Nisha, as you rightly mentioned, you know, the slippages have come in at a quarterly highest level of 15,737 crores. Now, unlike what we saw in Q2 and Q3, wherein 80% of the slippages were coming from unknown category or the standard book, this time 77% of the slippages have come in from the known stress book, that is the watch list and the restructured book. So overall, the watch list has now reduced to about 4,728 crore from 19,062 crore in the previous quarter. So that's a decline of 14,000 odd crores, and you know, approximately 11,800 crore have slipped into NPA in the current quarter. So now the bank says that the total stress book stands at 13,365 crore, which forms about 2.6% of their overall loan portfolio. All the brokerages have maintained their positive stand on the stock. Credit Suisse says that they maintain their outperformance rating. They cut the EPS on account of higher provision, and the target price now stands at 357 rupees. Nomura says that valuations are cheap when you compare to other private sector banks. It trades at 1.1x FY20 price to book value. They maintain their buy recommendation with a target price of 400. Morgan Stanley says that they have an overweight rating with a target price of 425. They continue to expect that, you know, the provision coverage ratio will move towards the 60% level by next year, and then you will start seeing ROE, that is return on equity, normalization. Deutsche Bank, they maintain a buy rating with a target price of 350. Valuations against are cheap, but lower near term, low ROE can be seen in the near term. CLSA maintains a buy recommendation with a target price of 425. Goldman Sachs says that fresh NPL has come out mostly from the stress book. They maintain a buy rating with a revised target of 380 rupees per share.
Okay, thanks a lot for that. So that's a buy coming in unanimously from brokerages. But here's more from Chanda Kochar herself, the MD and CEO of the company.
Gross NPA additions for the bank had actually declined during the first 3 quarters of fiscal 2018. However, during Q4 of 2018, the gross additions to NPA were elevated at 15,737 crores. The provision cover ratio on non-performing loans, including, of course, cumulative technical and prudential write-offs, improved to 60.5% compared to 53.6% last year. We will also focus on recoveries and resolutions And through that, by March 2020, we target to bring down the net NPA ratio to below 1.5%. We will also focus on increasing our provision cover ratio, and we target to take it to over 70% by March 2020.
Although the market is flat, it is in a mood to punish a lot of companies that have reported disappointing numbers. Tata Coffee is case in point. That stock is now down almost about 8% after a big slump in its EBITDA performance. And even Jubilant Food, actually, ahead of its numbers, is sulking. So maybe some disappointment getting priced, and you never know. But on to a CNBC TV18 exclusive. We learned from sources that Walmart and Flipkart are all set to sign a definitive agreement for Walmart to acquire a majority stake in Flipkart, and we understand the deal is likely to be made official in the next 24 to 48 hours itself. Shireen Bhan joins in now to give us all the details on what to expect from this mega deal. Shireen, take it away. Of course, you know, finally SoftBank will get an exit after a long time, but take it away. What are you picking up?
Well, it is a bittersweet moment for India's startup universe, guys. As CNBC TV18 learns, Walmart and Flipkart are all set to sign a definitive agreement giving the US retail giant majority control of India's homegrown e-commerce unicorn. Now, Walmart's impending purchase of a controlling stake in Flipkart will include about $2 billion of new equity funding, as well as it will see the entry of internet giant Google as a key shareholder in what will be the American retail giant's biggest acquisition to date in the e-commerce space. Let me take you through the deal structure now. What we are given to understand is that Walmart will buy up to 75% in Flipkart. This could be about a $15 billion deal, so it's a mammoth deal valuing the Indian e-commerce company at about $20 billion. This is, of course, source-based information. Now, the acquisition, which could be announced as early as Wednesday or Thursday, will be funded by Walmart with the existing cash reserves that it's sitting on and new debt. Walmart, as I pointed out, is expected to hold a majority stake, but the American retailer and Singapore-based Flipkart are in talks with other potential investors to also raise funds. That could see Google come on board as a new shareholder in Flipkart, and also the exit of SoftBank, as has been reported earlier by CNBC TV18. Other investors could also participate in raising funds, but that is post the acquisition closure. Also, Flipkart's financials will now be reported as part of Walmart International once the deal is done. Now, Flipkart is looking to leverage Walmart's retail expertise and, of course, its knowledge of the grocery and merchandise supply chain management. The investment by Walmart will help Flipkart build retail infrastructure, especially in rural India, and also help them set up an agriculture supply chain. That is what we're given to understand. Flipkart and Walmart will operate as distinct brands, so while there will be a lot of back-end synergy on the front end, they will continue to exist and operate distinct brands. Remember, Flipkart runs fashion portal Myntra and Jabong, a payments unit called PhonePe, and a logistics company called eCart. Walmart runs cash and carry stores. Best Buy is how they're called. Walmart, however, sees potential headwinds on its per share earnings post the closure of this deal, but in the long term, it sees this opportunity as being one that is EPS accretive. Now, the company is also expected to take Flipkart public and make it a majority-owned subsidiary in a few years. An Indian listing could be a possibility that could be explored. Now, a throwback. As we've been reporting, Flipkart, is a homegrown e-commerce story. It was founded in 2007 by Sachin Bansal and Binny Bansal, both former Amazon employees, ironically. The founders were not related, as well as early investors like Tencent and Tiger Global will continue to be represented on the Flipkart board. Walmart, Tencent, Tiger Global, and Google are also expected to continue to provide leadership to the Flipkart team going forward. Binny Bansal expected to stay on, Sachin Bansal expected to exit. This is going to shake up the Indian retail space, and of course it is now going to be a fight between Jeff Bezos' Amazon and Walmart along with Flipkart. For now, it's back to you guys.
All right, thanks Shireen for taking us through all those exclusive details. It is indeed the largest M&A on the street. Let's take it straight to the bonds market then. Bonds rallied sharply today on the statement from a finance ministry official that Reserve Bank is likely to conduct more open market purchases this year. Lata Venkatesh is right here to explain this to us. Lata.
Well, actually, if I can go with a little bit of economic theory, why would the RBI buy bonds? Every year, the Reserve Bank has to print fresh cash into the economy because the economy grows. So you have to put more cash. Now in India, you have to put cash into the system for another reason, because there is a very high rate of withdrawal of cash from the banking system. Indians are still a cash-ridden economy. Now it's difficult to make comparisons over the last 2 years because these are demonetization years. So let me just begin with the math that the market is working with. Going by the statement made by the Finance Ministry official that RBI is likely to do a lot of OMOs this year to smoothen government borrowing. When we started this year, the excess liquidity in the system was 1.7 trillion rupees. This was the money that banks were giving on a daily basis to the RBI because they had excess cash. Now, through the year, the expectation is that currency will leak to the extent of about 20,000 crores a month. This is an average. Some months it leaks, to the extent of 1 lakh crore. Some months it drops to actually money coming back to the system. Festival months withdrawal is very high. But if you take an average, and that's what the economists are working with, about 2.5 lakh crores is withdrawn from the banking system. That surplus liquidity that we started with immediately becomes negative liquidity of 1 lakh crore. Now, usually you can also, the Reserve Bank has been in the last 1 or 2 years buying a lot of dollars and putting cash, replacing the cash. But this year, that excess dollars is unlikely to happen because it is a high crude price year. Therefore, the balance of payments may be zero. We may not get net inflows. After all, we know that FII purchases in both bonds and equity has been negative year to date. Additionally, of course, the very sentiment on crude could keep away the excess flows. So assuming that RBI is not able to buy any dollars, how will it push that 1 lakh crore into the system? It will have to buy bonds. So that is the math the market is working with, that RBI will have to do at least 1 lakh, maybe some people are even talking about over 1 lakh crore of bond purchases through the year. What has made the market happy is the Finance Ministry guy's statement that RBI is doing OMO to cool yields. I seriously believe that RBI will be unhappy with a statement like this, but that is the statement that's come from the Finance Ministry, and that's made the market very happy. Every time it goes to 7.75, they expect RBI is going to come and buy bonds, and hence a celebration today. I think 7.5756, it went as low as that.
And Nifty 50 is really holding up at 10,710 levels at this point. Now let's take it straight to the earnings central now, and Godrej Consumer reported its fourth quarter numbers, and fireworks, exceptional gains boost the profit after tax for that particular company. And Manglam Malu gets us all the insights. Manglam.
Absolutely. So, Nisha, there were no fireworks in the numbers if you take a look at those numbers, but it was the management commentary which got the street excited, and which is why the stock is sitting with a gain of about 2%. Just to look at the numbers, revenue at 2,530 crores, that compares with a poll of 2,563 crores, so 30 crores below expectations there. EBITDA 597 crores, compares with a poll of 605 crores, so pretty much in line if you must. The net profit, that came in at 617 crores, that compares with the street expectations of 435 crores. Why did that happen? Well, because the company went ahead and posted an exceptional gain of close to 194 crores. So in terms of numbers, really no fireworks, because the volume growth at 6% pretty much in line, if you must, a lower end of our expected range of 6 to 8%. So in India, they have three businesses: soaps, hair colors and household insecticides. Both household insecticides and hair colors were the ones which disappointed. Soaps grew at 19% as against expectations of 12 to 15%. The management said there were one-offs in both hair colors and the household insecticides business, so they expect recovery out there. International business, that was muted. Indonesia, we were expecting a growth year on year and modest recovery. That did not happen. 11% is the decline in the Indonesian revenue. But the management says they expect a strong turnaround in growth rates in fiscal year 2019. They're confident of delivering a stronger performance in the next year. So they're reiterating their confidence, and they're planning significant new launches. So let's see what happens. The stock is excited with the management commentary more than the numbers.
Absolutely. So many segments have actually not done well, but management commentary was good. Thanks, Manglam, for that. But moving on, the total net equity inflows into mutual funds have actually fallen 12% on a month-on-month basis. To get us all the numbers, Surbhi Upadhyay is here. She'll highlight the data for us. Surbhi, over to you.
It's a mixed picture for mutual fund inflows as the financial year kicks off. We're talking about the April data, and it depends on how you want to look at it. Glass half empty or half full. Well, let's take a look at the first number, and that's the net equity inflow number. For April, we're talking 16,214 crores. Now, without sort of getting too micro on it, The hard fact is that this number is lower compared to the March inflow number, which was closer to about 18,500. It's also lower if you compare it to April of 2017. So there's a 5% dip year on year and about a 12% dip month on month. However, the good news is that redemptions have started slowing down. So from an extremely high level of 45,000 crores of redemption, we're now down to a figure of around 19,900. So month on month, that's about a 55% drop in the pressure with respect to redemptions. However, redemptions are still high if you're comparing it on a year-on-year manner, because then again, there's about a 40% increase. Let me come to the other good piece of news. That is that pure equity inflows are looking good. They're looking quite solid. In fact, there's about a 300% jump month on month if I talk about the money coming in pure equity funds. That figure is now close to 12,000 crore rupees, much better than the minuscule number that we had at the end of March. The big talking point, however, is the ELSS trend that's really picking up. Now here, it's quite interesting. You can't really compare March with April because of the year-end factors playing out. But even if you compare the ELSS numbers with previous April, even then there's a sharp dip. So on the ELSS, that's a sticky money. The SIP inflows that are coming in, there's about an 89% drop month on month and about a 23-24% drop even if you look at it year on year. So we have to see whether this is just an April aberration. A lot of the mutual fund experts say that, this is when people are signing their folios. So maybe it's just a sort of a change of dates, and gradually this number will start picking up. Finally, balanced funds are seeing outflows, and that's because of the dividend distribution tax that's now come in the LTCG era. So balanced funds are no longer that attractive, which is why there is a drop both month on month and year on year in balanced funds as well. All in all, the question is whether this number of 16,000 odd crores is now the new normal, because at the peak of the market cycle in around January, February, we had touched a level of 22,000 crores in terms of the net monthly inflow, which is now down to about 16,000. So it remains to be seen whether we stabilize here or whether numbers can actually start picking up as the year rolls on.